Is a subdued market upturn really on the horizon? Or are we all just doomed to keep riding the roller coaster of unpredictable property prices? Today is part 2 of 10 key themes for the New Zealand property market in 2025. We're cutting through the noise with the popular Nick Goodall from CoreLogic and what it means for you next.
Financial freedom faster. Financial freedom faster.
If you want the real story straight from the source, subscribe to our channel. After all, great conversations create great insights. Nick Goodall's the wizard who turns mountains of data into crystal clear insights that could give even the most jaded economist a run for their money. Nick, you've got 10 key themes for the New Zealand property market in 2025. We looked at 5 yesterday. That link is up here if you missed it. Let's have run into this next key theme of affordability to remain a lingering issue.
Yeah, so carrying on from the theme with the DTIs, I suppose the fact that it's going to restrict how much activity comes from there, we think it should mean that affordability doesn't run away. We don't see value growth like we have in the past. So affordability doesn't take off like it'll get worse in the same rate that it has in the past. What we show here is our 4 measures of affordability in a couple of charts. The one that we're really paying attention to is the black line, the left-hand chart, if we do have a visual there, which shows the proportion of income required to service an 80% LVR mortgage. And what you can see there is in the last 2 years, it's hardly really improved, because even though values of property has declined, interest rates increasing have meant that it's still really hard to service a mortgage. Now, in the latest quarter of data, and actually we're going to add one more quarter to this, we'll release an update on this affordability report, which will be put out for free, by the way. That'll come out next month. When we see that, there's actually 2 months of improvement of affordability. But the one thing I do still point out is that black line, while it has improved in the last 2 years, it still is above the long-term average for the proportion of income that's typically required to pay a mortgage off in the last sort of 2 decades. And so it is still relatively stretched. The amount of income required to service a mortgage today is still more difficult than most years in the last 20 years. And that will just contain the amount of demand which does come back into the market as interest rates fall away. So we do see things improving, and that sees demand lift and sees, competition for properties increase and prices increase off the back of that. But maybe it's a bit more constrained than when it has been, or what could have happened if prices weren't so high and interest rates were still, in that sort of mid-range period, I suppose. I think on the last point as well, that rental affordability, that is something that's really still quite stretched right now. The only line which is still increasing is the grey line on the right-hand chart. That shows the proportion of income required to pay rent now compared to the last decade. Still quite difficult. Rents are still increasing as incomes are, and so it's still stretching those renters, the affordability of renters, and that can impact their ability to save a deposit as well, to become a first home buyer if they so desire as well. So that might just slow down that activity of first home buyers as well. So I think it's just one thing to note. Affordability still sits across everything, and it will contain the level of true demand which comes forward because they can't afford to get that mortgage.
Yeah, I think it's often forgotten how expensive it is to own a property. and that certainly in the last 5 years, paying a mortgage is a lot more expensive than paying rent. And it really is concerning, I guess, of how much income people have to spend on their rental payments, and getting them out of that rut is difficult. What is the magic solution, I guess, is average incomes in New Zealand really have to go up, and that's a bigger problem, really.
Yeah, and that's a broader situation for our economy, for our labour market. We need to be more productive too, because productivity actually improves our income on an hours worked basis. So then you can do more things if you want more income, right? If you get some time back. So yeah, there's a pretty big, broad discussion there, which I know that plenty of economists have got opinions on, and the government are looking into pretty strongly as well. But you're right. The best thing is to see incomes grow, maybe not see the same price growth and values of properties, and allow that affordability to catch up a little bit, which then starts to boost the broader economy off the back of that as well.
A reminder, if you're determined to outsmart every other New Zealand property investor, smash that subscribe button now and join our elite circle of market trailblazers ready to dominate the game. Now let's go into theme number 7, subdued rents for the foreseeable future. Now, what is going on? It's very low yields for investors by the looks of it.
Yeah, that's right. I think rents have been slowing down. So rents are still increasing, but the growth rate has slowed down. And that's really because we've seen an increase in rental supply. There's more properties available for rent. Demand is still growing, but it's growing at a slower rate as well. So you got to remember these things are still increasing, but the rate of increase has slowed down. So things have improved from an investor's perspective in terms of the rent you'll be getting previous to, say, 6 months ago or a year ago, but it's not increasing at the same rate it was a couple of years ago. And when you look at some of the figures around rental growth rates, they've been upwards of 6 or 7% per annum for a while there. They're now reducing in that rate of growth, closer to the longer term average of sort of 3 or 4%. So it's still increasing, but in terms of covering cost, it's still pretty tight for any landlord trying to figure out how they're going to get rents to cover all the costs they've got themselves. So that's just one thing to watch, and that rate of growth has been declining. From a demand perspective for rental properties, as I said, supply has increased. Demand is still increasing, but the rate of growth, once again, is slowing down. And this is really when we try and look at it, measuring it by migration. How many people are moving to the country, minus those that are leaving the country? It is still net positive, so there's more people moving here than leaving, but the rate of growth has slowed down. We were upwards of 120, 130,000 net new people living in New Zealand a couple of years ago. Now it's back around under 30,000. So, there's just not that same hyper level of demand for rental properties as we've seen in the past. And so once again, there's just less reason to think that rental growth is going to take off because there's so much demand. Supply might be reduced, and then you see rental growth take off the back of that, especially if incomes are increasing as well. So it's just, again, setting probably more of a longer term expectation around rental growth, that it's probably likely to settle in that long-term average of 3% rather than something we've seen in the past at that 5 or 6% rate, which supports that yield for those investors, which, as you say, it's not great. It's improved, but it's not great compared to maybe things we saw a decade or two ago.
Yeah, and I know here that you're saying that the history shows tenants' affordability matters more than landlords' costs. And, despite how much investors would like to be able to pass on the cost, they can't always do that, right?
That's exactly it. There's plenty of data and studies out there that show that rental costs are much more in line with tenants' income than what it costs to own that property. So whether the property costs more because they can't write off depreciation, or they've got things like capital gains taxes, or interest rates go up, the truth is you can't really pass on those costs to the tenant. You generally charge what they can afford, and that's much more consistent over time. Now, there'll be tweaks here and there, but the long-term data does tell us that it's more about the tenant income than it is about the landlord costs that dictate where that goes to in the future.
Yeah, that's why it's so important to buy well. So with the bonds lodged dropping significantly away from these peaks, is this because people are staying in properties longer and there's less bond lodgements? What's going on?
Yeah, that's actually the growth in the dollar value of those bonds that are lodged with the Ministry of Building, Innovation and Employment. And so what that's really telling us is that's saying of all properties that are rented today, what's the median rent change?
Yeah.
And it's not as fast moving as, say, the Stats New Zealand CPI measure, which is only looking at new rentals which have gone to market. And so really what that's showing is what are new properties that are being rented, or not new properties that are newly rented or just recently rented over time. How's that changing compared to the whole stock of all properties where a bond has been lodged on that property? And one thing you can see there is that the orange line, the Stats New Zealand measure, is a bit more reactive to recent market change, and it does drop and increase a bit more than the overall one, which can be a bit more slow moving.
Okay, great. So let's go into theme number 8, construction sector to have a better year. Flatter costs should also entice some households back. So there's new dwellings consented and forecast. What's going on there?
Yeah, so this is our quick look at the construction industry. I think it is a key theme. We've heard lots about property prices in general falling, but I think the thing for us is that you're always seeing these headlines about a property development company going into liquidation. And there is this concern about, can we keep building the amount of properties we need to support our population growth? Are we going to run the risk of having an undersupply of properties because we're not building anymore? And we're well down on our consented peaks. I think I touched on it earlier. 51,000 properties were consented at its absolute peak for 1 year. That's now dropped to around about 30,000. Well, we actually think 30 to 35,000 is probably a more sustainable level where we should be building consistently between 30 and 35,000 new dwellings per year, every year for a long period of time, because we do have strong population forecasts, and we've had strong population growth in the past, which we haven't really kept up with in terms of housing those people. So there's some long-term context here that's required. When we look back at the global financial crisis, which did hit the construction sector really badly, consents dropped to between 10 and 13,000 per year. So we're well above that low of the market, and it looks like consents may be getting to a trough now. So we might see some growth come back, and anecdotally, we've heard a bit more positivity in the construction industry. We've touched on some of the reasons why people might shift back to constructing new as well. Affordability is starting to improve, building new compared to existing. You can get outside the lending restrictions, both loan-to-value ratio rules and debt-to-income, to go into the new build. So we expect that to push some demand there as well. And as your last point was, in terms of the cost to build, it's still increasing. Once again, it doesn't really go backwards. It's still increasing, but the rate of increase has reduced dramatically. So again, we're talking about growth in construction costs increasing at around about a rate of 3 or 4% annually, down from what was upwards of sort of 10% annually. So things are starting to improve from that perspective too. And so, for the value you get from building new compared to buying an existing property, which might require some work, the value conversation is going to come back into it for people too. So again, we're not saying, there still could be some time of decline. There still could be some uncertainty for building new, and people going, am I really going to build a new property when it's not finished for 18 months? What's my income in 18 months? What's interest rates doing in that time? There's still some uncertainty, which might keep some people a bit cautious from it. But things are definitely better today as interest rates fall, as job certainty starts to increase than they were, say, 12 to 18 months ago when there was much more uncertainty in that market. So maybe a little bit more of a decline in the construction industry before things start to improve maybe in the second half of this year and certainly into 2026 as well.
Yeah, it's good to see construction companies really having to compete for the work now, and instead of having to chase builders to quote, now these guys are it's swung back around. Yeah. A reminder, ready to claim your competitive edge in New Zealand real estate? Hit that subscribe button and tap into exclusive insights that'll leave your rivals eating dust. So key theme number 9 is the economy to grow again and unemployment to peak and fall. So this is really about GDP and the unemployment rate. We're expecting things to get better.
Yeah, and I think there's probably a little bit of, cautious optimism, I think, here, not just from ourselves, but from the government themselves. I think when you talk to, whether it's the private economists too, they do have forecasted GDP growth, which essentially means our economy expanding, more businesses doing better this year than they did last year. But as I touched on earlier, the main reason for that is because of interest rates falling. And the Reserve Bank say it themselves. They know the economy needs support, inflation is under control, so they can reduce the official cash rate, reduce mortgage interest rates, starts to put more money in our pockets. We go out there and spend more, so businesses do better, they start to invest in the future. And it's a bit of a cycle there, right, as to how that all flows through, the money flowing through from our pockets into those businesses. And when you look into the detail of any GDP forecast, there's not really much in there that says, government aren't saying they're going to be spending lots this year. We're not expecting tourism to take off, for example. It's not like farming. The farmers are going to be doing much better this year compared to last year, other than maybe them paying lower interest rates as well. So, I think there's no real major part of the economy that's going to do better this year than the last couple of years. It's really about consumers consuming more. Us householders actually going up there and spending money because we got more money in our pockets from those lower interest rates and lower mortgage payments. So that's the key contributor. And that's part of the reason why we expect the Reserve Bank to continue cutting the official cash rate so that we continue to see these falling mortgage interest rates, falling mortgage payments, and so we start to be out there and spending more and giving that certainty to those businesses. So that's a core part of the recovery here, is the official cash rate falling, and that's why we still expect those cuts to come in the future. Unemployment and the job market's a key part of this as well. As those businesses start to do better, they see better forecast themselves with their own revenue. They know they can hold on to their staff, and so maybe there's going to be less unemployment out there as well. And so, as you said, we do forecast, or many of the economists are out there forecasting unemployment to peak very soon, either this quarter we're in right now or Q2 this year, before the unemployment rate starts to reduce in the second half of this year again. So as businesses get more certainty, start to do better, hold on to their staff, employ more people, that's when we'll start to see that improvement through the labour market as well. So there's a little bit of hopeful optimism, I would say, here as well, but it's based on those forecasts of the official cash rate dropping as well. So there's good reason for that to come through this year. And that, of course, means flowing through to the property market too. When you look at the property market, so much of our economy really is dependent on the property market as well. Not like just, mortgage advisors or real estate agents that benefit when properties turn over, but there's moving companies and there's a number of different industries and economies in New Zealand which rely on property transactions, and we do expect transactions to start to lift as our economy improves. So it's all tied in together.
Okay, well, let's go on to key thing number 10, which this really grabbed me when you talked about it the other day. So some context and long-run thoughts. It's been a prolonged and deep downturn. Future house price growth could also be slower. And there was a couple of key points, if you can run us through them.
Yeah, of course. So the one chart we show here is basically what have property values done since the peak of the market this time around compared to the last time we had a major downturn, which is the global financial crisis that kicked in 2007 and ran for a few years. And the really interesting thing here is the global financial crisis, property values dipped by about 10% in total before slowly increasing back to that peak. And values didn't get back to that peak of 2007 until 5 years later. Now, this time around, the decline in values has actually been greater. So we've seen a greater decline. Now we're a few years later, so we haven't got to that 5-year period yet. But for values to get back to that peak, if it takes 5 years, we're going to see some decent growth. It might even take longer. So that peak of the market this time around was 2021, 2022, end of 21, start of 22. If we see 5 years, it's not going to be until 26, 27 before values, make up that decline we've seen and get back to that peak of end of 2021, for example. So just setting expectation that it does take some time for that recovery to play out. And then when we look at that long-term context, I sort of got these 4 icons. So I say, these are the key things which have influenced property prices over the last 4 decades. And so we work through each of these different main factors and then say what influence could they have in the future. So I'll work through each of those ones. Interest rates, we have a little arrow down with a percentage there. Interest rates have declined dramatically, fundamentally have changed over the last couple of decades. From an average long term of 20-odd%, 50 to 20% for a long period of time, now to a position of around about 5%. Now, that's a significant fall away. They can't fall from 5% to, negative 5% again. They can't fall by that margin again in the future like they have in the past. So that dramatic shift, and that's one thing that led to strong property price growth in the last couple of decades, can't really happen again. We'll see some falls, no doubt. We'll see some increases, of course, as well. But that fundamental shift in interest rates from 20% to 5% can't happen again. So that's unlikely to push prices up in the future as they have in the past. The other one is land availability. Land availability and restriction on land use has been pretty significant in the past, and that has been something that's contributed to long-term house price growth over the last 10, 20, 30, 40 years. Now, we have seen some improvements to the ability to build land and build on land, intensification, encouragement for densification, approved and agreed by both of our major parties in New Zealand. So I do think that land use and land use restriction has changed pretty dramatically in the last couple of, probably years, and certainly in the last 10 years. Auckland Unitary Plan in 2017, that's one of the factors, but also things like medium density residential standards have meant we can build more on less land, and that will also restrict how much property price growth we see in the future compared to the last few decades. The other one is household income growth. So, 10 or 20 or probably 20 or 30 years ago, most households had one income earner. In the last 20 or 30 years, we've moved to this, fundamental shift to income earners per household. What does that do? Almost doubles your income over that period of time. Means you could borrow more, means you could pay more for housing. Now, that can't really happen once again either. Unless we start to move to triple household incomes or more, we can't see that borrowing power increase in the future by as much as we've seen in the past. So the fact that we saw greater incomes and incomes increase so much, so dramatically in a short period of time, that led to part of the house price growth we saw, say, a couple of decades ago. That can't happen again either. And so that will definitely see less house price growth in the future than we've seen in the past. And the last one is government. Government restrictions, government influence as well. We have seen that that's changed over time, and potentially, there's much more discussion now about, do we need to rebalance our tax take in New Zealand away from income tax and how much we tax our income by, to something else, capital tax, capital growth tax, wealth tax. Now, I'm not saying those things will happen now or next year or even in the near future, but it would probably make sense that at some stage in the future, we're going to see a shift in the way we tax incomes in New Zealand, not just from the income that we get from our wages, but towards some form of capital and wealth tax as well. When that happens, who knows? But that will also be a key influence on what future value growth looks like compared to the past. And so the way I frame this up right at the end then is to say, if you look back at the last 4 decades and everyone talks about property prices double every 10 years, and I think, the average compounding annual growth rate for property prices in the last 30 or 40 years has been in that 6 to 7% range every year, year on year. All we're saying is we expect, because there's key fundamental contributors to that growth, can't really happen to the same degree in the future than they did over that 4-decade period. Maybe we're in for a longer term reduced capital growth rate than we've seen in the past. And maybe that growth rate longer term looks much more similar to our income growth rate of maybe 3 or 4%. And as our income grows, we can borrow more, we pay more at property prices, and that would be a much more likely trend of property price growth than what we've seen in the past around those 6 to 7, because those fundamental things can't really happen again. Now, I'm sure people have said that in the past. 10 years ago, they would have said it, and then it happened again anyway. So I'm sure there'll be something in the future which will change, whether it's a fundamental shift to our labour market, or I don't know how interest rates work, or incomes change dramatically for one reason or another. Who knows? The use of AI. Something will probably contribute to this being different than our expectation. But if you take a conservative central scenario, 3 or 4% growth in property prices per year looks more likely than the 6 or 7% we've seen in the past. So, we'll see how it all pans out. But that's, if we use our common sense, I think that's where we sit at the moment.
A reminder, don't let your competitors steal the spotlight in New Zealand's property market. Subscribe now and get cutting-edge strategies and insider secrets that guarantee your success. Nick Goodall from CoreLogic, Head of Research. Thanks for joining us today.
Awesome. Thanks so much for having me. Enjoy.
More cash,
Thanks,
passive
man.
income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial freedom's in your hands.